Vroom is a used car retailer that lets consumers to buy/sell used cars online. I read multiple comments asking me if I'm gonna make a video about this stock. According to Google Trends, the interest in this stock has increased in the recent days, as the stock is a potential candidate for short squeeze. And this is one of the most shorted stocks, almost 30% of float shorted. Will it actually happen or not? I can't say, because I can calculate the motion of heavenly bodies, but not the actions of chaotic crowd, as Newton said. A potential short squeeze could actually improve the company's finances if a short squeeze will significantly increase the market capitalization of the company and it will launch a new public offering. Right now the market capitalization is less than $200 million. A year ago it was $6 billion. And now the valuation ratios are so low that it looks like the market is pricing in a potential bankruptcy. And yes, if we look at the current cash burn, in the first quarter of 2022, the company had a net loss larger than the current market capitalization. The company is not going to become profitable in the next few years, and it has only $600 million unrestricted cash. Announcing a public offering with the current market capitalization will not help at all, and the current market situation is just not in favor of these companies. The FED is raising the key rate and tightening monetary policy, absorbing liquidity, and there are also concerns on the rise that the bubble that emerged in used cars due to supply chain headwinds like the chip shortage has peaked. In 2022, the company showed an impressive growth of revenue thanks to an increase of used cars prices. Of course, the number of total cars sold has increased too, but it's not growing much since the second quarter of 2021, and now used car prices stabilized and used cars market can even cool down. This can have a significant impact on Vroom's profit margins. Despite basically the perfect storm for this company, a 97% drop in the stock price is not justified. Basically, the market just gives away this business for free. According to the company, now it's going to prioritize unit economics over growth. Apparently, previously the company wanted to achieve growth at all costs. The company wants to reduce operating expenses and maximize liquidity, which is totally reasonable. The company plans to end this year with $500 million in liquidity. So even if the company is going to bankrupt, it's not going to happen soon. The management intentionally slowing down of the business growth. Now revenue is forecast to decline this year and then is forecast to grow at much lower rate than it was before. Despite the fact that the company is going to change its focus on reducing operating expenses, the company's cash burn is still expected to be pretty high. The company's debt is not that high, especially compared to its competitor Carvana. Vroom's only long-term debt is $625 million, 0.75% coupon, 2026 convertible. So far, it does look like the company is going to be out of funds sooner or later. But there are examples of companies that were close to bankruptcy multiple times and survived against any odds, which doesn't happen often. I think the main risk for companies like this one is the fact that the era of cheap money and zero interest rates is over. Now it's going to be much harder for companies like this to survive. Companies with a lot of money on their balance sheets will have a great competitive advantage because they will simply have money to grow. Many companies will go bankrupt and those that survive will get rid of competitors. That's all for today. Thank you for listening.